Let's move on into chapter 15, which is a chapter that covers investment companies. So let's get right into it. Studies indicate that few individual investors can consistently outperform the broader market indexes. Okay, we've established that. Furthermore, few individuals have the knowledge, the time, the money, or the emotional constitution, okay, the fortitude, to do what it takes to assemble and monitor a diversified portfolio of individual securities. If you don't have these traits, these abilities, and the time, okay, then what is your option? A managed investment company, otherwise known as a mutual fund. These are an appealing alternative to direct investments, buying stocks one at a time, stocks and bonds one at a time on your own, because they provide several helpful services. So let's look at some of the services that mutual fund companies or investment companies provide. Specifically, investment companies provide the following. Instant diversification. When you buy a mutual fund, you're buying into a portfolio that has a number of stocks in it. Now, we're going to go over in some later slides the traits or characteristics that you need to review as you look at a mutual fund. Some mutual funds are much more diversified than others. So just because you're buying into a mutual fund doesn't mean you're getting great diversification, but there's a great opportunity that you can buy into diversification, but that's something you're going to need to check. Okay, so you are going to own, when you buy shares of a mutual fund company, you will own a pro rata or percentage of a portfolio that contains many securities. You also get investment flexibility. There are a wide variety of mutual funds out there that meet many different types of objectives that investors have. You get professional money management. These people are highly trained, highly educated. They watch the markets very closely every day, and they analyze securities in an effort to buy stocks that are undervalued, whether they're growth or value. They develop and maintain portfolios that have specific objectives and characteristics. And so there are so many funds out there that enable you to really slice and dice the market into pieces, and then you can fill those pieces, address those exposures that you want to have with these individual mutual funds. All right, then you get account administration. The companies keep track of your account balance, your cost basis, how much you've invested, and that's for capital gain purposes, gains, losses, dividends, and interest, all for your tax record. So they keep up with this, they send this information to you, and they also provide a limited amount of performance data on the fund. We'll go over performance in just a couple of minutes. All right, so what is the essence of an investment company? Well, I'm glad you asked that question. An investment company or a mutual fund issues shares to the public. It's a company that goes public with their stock. They issue stock to investors, okay? These shares represent ownership in the investment company. Well, what does the investment company consist of? All right, the investment company uses the cash proceeds from the sale of its shares to invest into securities issued by other publicly traded entities. So you are buying the shares of a company that is in the business of buying the shares or bonds of other companies. All right, therefore, each person who buys in an investment company owns a pro rata share of the investment portfolio built by the investment company. All right, so that's what you're buying. You're buying into a business that is in the business of assembling portfolios, picking stocks and bonds. The value of the shares of an investment company depends on the value of its investment portfolio. The net asset value, a very key term, net asset value, is the total market value of the investment portfolio divided by the number of shares issued by the investment company. So the total market value of the investment portfolio is the sum of the market values of each security investment. The market value of each security investment is the total number of units of each security owned times the current market price of each security, and this is something that you have gone through as you have valued your own portfolio in our stock game. All right, let's see how far we're going here. 51 more. Last slide. So an investment advisory firm, a company that consists of analysts, okay, will register a fund with the SEC. So they will contact an accountant, they'll contact an attorney, they'll put together the paperwork and file forms with the Securities and Exchange Commission. They will then select a board of directors, like any publicly traded company would. They'll hire portfolio managers and analysts, and then they will market their shares to the public. Okay? They then, so they market their shares, they sell their shares, they take in money, and they start making their investments. The fund will levy a management fee that ranges from 0.1% to 2%. Sometimes it's higher, depends on the kind of fund that we're talking about, but roughly you can capture most of it between, really these days, between 0.5% up to, I would say, 2.5%. That captures 99% of the range of fees that are out there. And so the fee, the management fee, is a percentage of the market value of each account balance. So you take the account balance on a specific day, multiply it by this fee amount. And this fee amount is an annual amount. So typically, mutual funds charge on a quarterly basis. So you multiply it by the fee rate and then divide by 4 to get your quarterly rate. And this covers the cost of doing business, plus hopefully adds some profit for the firm. Okay. Most investment companies, make sure we're not going too far, most investment companies operate a variety of funds. They're called fund families, different types of funds. Why do they do this? They do this to achieve economies of scale. Once you set up your company and you make the initial investment in what it takes to have an investment company in terms of equipment and space and analysts, then you want to offer different products so you can sell products to as many people as possible. So you want to leverage the staff and information infrastructure to cross-sell products to the customer base. Once customers become familiar with your brand, you want to have different products to sell to people. It takes as much time, remember this, if you ever get in the investment business, it takes as much time and as much cost to manage $1 million as it does to manage $50 million. So you might as well go for the larger asset base, because remember, your fee is equal to your rate times your market value. So you'll earn a lot more on 50 million than you will on 1 million. You'll earn 50 times more. Okay? Also, the more funds that you have to sell, the wider your appeal will be to investors who have varying risk-return objectives. You want to have a number of different products so that once someone becomes familiar with your company and likes and trusts your company, you can sell them a number of different products. Okay? All right, we're going to stop it there, and we'll move on in the next clip to discuss some individual types of funds. Peace out. Shalom.